Hello, everyone. It is Friday, the 3rd of February. And today on the final bar, you will have to deal with me as we have sent Dave off to his family in Cleveland for a long weekend. However, as usual, we will still wrap up the week and take a look at how markets behaved and moved and how it impacted the technical conditions of our charts. And on top of that, I will answer a few questions from the mailbag. Ladies and gentlemen, this is the final bar. Hello, everyone. As you may have noticed, Dave is off for a short vacation with his family, and I am still not entirely sure what happened, but all of a sudden I was promoted to co-host of the final bar. So here we are. For those of you who don't know me, my name is Julius de Kempenaer, and I am presenting to you from Amsterdam in the Netherlands. This week was sprinkled with macroeconomic news and information, as well as a lot of earnings reports. We had the Fed day on Wednesday, Meta reported earnings on the same day, and yesterday we had a couple of mega cap names like Amazon, Alphabet, and Apple reporting. As usual, some of it was good, some of it was not so good, some of it was outright bad, and the markets had to digest a lot of information. And of course, we will try to make sense of all of that using the charts that you can pull up yourself during the trading day here on StockCharts.com. However, before we are going to take a look at last week's performance a little bit more in depth, we need to take a look at the poll results. We always have a poll running, which you can find on our live stream page and on the Final Bar social media accounts. And this week's question was, which ETF performs best over the next 3 months? And your opportunities, your options were ICLN, that's for clean energy, FANG stocks, FNGS, oil and gas, XOP, and gold, GDX. And drum roll now, the results are in, and it's a whopping victory for FANG stocks, FNGS. More than 50% of you think that FANG stocks will do the best over the next 3 months. So let's take a look at that. As the RRG guy, I couldn't resist putting those 4 stocks on an RRG, and this is what it looks like. And if I do a quick rundown of that RRG, then I almost suspect that all of you have been watching that RRG when you pulled up that poll, because FANG stocks are indeed the strongest still. They're inside improving, moving towards leading, and out of these 4, I would say that FANG stocks are the best choice. Gold is rolling over, oil is already inside lagging, and ICLN is making a weird move just left of the benchmark. So all in all, I think that you, as in the listeners and everybody who participated in the poll, are on the same page as I would be using an RRG, and we'll look for FANG stocks in the next 3 months. Now let's go to a further move into what's happening in the markets. And I'm going to use our new charting platform, ACP, for that. And because I think it gives a nice overview. We have the candle glance, of course, in sharp charts. But what I like about this setup here, and by the way, these are all 30-minute charts. So that gives me a pretty detailed rundown of what happened last week for all these major indexes, bonds and dollar and the volatility index. But what I can do, and I'll show you that, is I can toggle them and make them bigger and make them blow up. So if we go to the S&P, here is your 30-minute chart that starts at the end of last week. That was the 27th. This was Friday. And then we have on Monday, this is where Monday starts. So Monday was a pretty weak day, and then the week started to improve. Obviously, on Wednesday after the Fed, we had that big surge in prices, and we're now stabilizing. So today, actually, we started off pretty weak. We rallied back, and we're now touching that lower end of the range of this morning. So that is in the close. that is, I'm glad it held up there actually. So for now, we're still good on the S&P 500. We're well above that 4100 line, which is the line in the sand. So for the time being, it looks as if we're good. We go to the Dow Jones, that was slightly different. You can see there is a much more of a trading range going on in the Dow. That's the story that we had this week, where especially the S&P and the NASDAQ were doing really well. And here is the NASDAQ, which we have seen jumping like crazy on Wednesday. But it's digesting now. We're really holding up. And I think that is, we should see that as good news, as long as especially the S&P and the NASDAQ are holding up at current levels. We have the small caps here, S&P 600, same kind of move, nice gently up move, holding up above those levels. We have in Canada, we can see that it isn't as strong. It hasn't jumped to new highs there, but in general, that market is also holding up nicely for this week. And let's have a quick look at the bond market. So TLT, opposite of what's happening in stocks, we had that big move down, and we're holding here around that 106 level, this area, which was support late last week and earlier this week. We're holding those levels right now. If we go to the next segment and look at the sectors, you could have, obviously, we can look at that sector summary that a lot of people use on the site, and it gives you a nice rundown of what happened today. And you can see that consumer discretionary, utilities, real estate are really at the lower end of the list, while financials and energy are doing really well. But what I try to do when I look at sectors, I bring up obviously an RRG that gives us the rotations during the week. But since not too long, a couple of months, we also have intraday RRGs, and that gives you a real good opportunity to look at how these sectors performed and rotated during the week. So what we have here is a 60-minute RRG. So it looks at every node here is 60 minutes. And you can actually see how big those rotations are. And so 30 times 6 is almost 5 days. It starts somewhere mid-morning on Monday. And you can see that 6.7 for communication services versus minus almost 4 for energy. That's a almost 10% dispersion through the week. That's quite big. If you use a normal RRG and you switch that period of trading days to one trading day, you can actually see the performance of one day, and that comes very close to what you will see on that image, that widget on the homepage. So just to give you a rundown here, this is Feb 1, 31, January 27. That's Friday. So boom, here is Monday morning, and you can see how these rotations have taken place. And I realize that 30 periods maybe is a little bit too long, becomes messy, so I'll put it like that and give you a little bit of a better view, and you can see how that moves. And at the end of the week, we're now here, communication services, discretionary, and technology, they're giving back a little bit of what they gained over, especially since Wednesday and Thursday. But you can see that intraday, those sectors are now leveling off and losing some relative momentum, while sectors like financials, healthcare, energy, industrials, they are picking up right now. If we bring that, you can also bring that into the ACP chart. And I love to combine that RRG with this 12 image, this 12 graph setup in ACP, which I can then again toggle back up and down. And these are 60-minute charts, so they match the RRG that I had here. So you can play back and forth on the RRG, and then you can look at the performance of the sector. So let's pick up consumer discretionary, because I think that's consumer discretionary, communication services. That's where the biggest moves were this week. And if we bring up this chart here, so this is the hourly chart, let's make it a little bit longer, and you can see how that improvement went, and especially that it took out that overhead resistance that was looming against, and we had Here at the end of January, we hesitated a little bit, and here on Wednesday, that jump actually brought it back up, and we got back to the old adage where old resistance becomes support. So we're looking for support in XLY around 149, 150. If we're going to put in, if the market is able to put in a new low around those levels, I think that the consumer discretionary sector remains in good shape. We go to communication services, which was obviously heavily impacted by the surge of Meta. We see that really big gap there on Wednesday. But you can see the overall performance that's been going on here since late December, actually. And also here taking out important overhead resistance already a couple of weeks ago. That was here around 50, and now really jumping higher. So there's a big gap here on this chart. Gaps must be closed is a well-known saying, so we'll have to watch and see. I think that the overall construction of the market has been improving last week. We broke some important resistance levels, and right now I think that what you need to look for here in communication services, because this sector has been improving for a long time already. If we take out this low, we could be in for a close the gap move. But that is a minor move. That fits into the narrative, fits into the setup of a market rallying and coming back down. So all in all, I think that the market has improved quite a lot. We've taken out 4100 line in the sand for the S&P 500. So far, we're looking good. Looks as if market is rotating out of defense. All in all, this was a good week, despite the little loss that we had today. But all in all, the improvement is there. We are now going to wrap up this segment of the final bar. We're going to go to a little commercial, and after that, I'll be back with your questions in the mailbag. Welcome back, everyone. Once again, I am Julius de Kempenaer, broadcasting to you live from Amsterdam in the Netherlands. We are going to continue on with the final bar mailbag, where I'll be answering some of the questions that you have sent in. But first, I need to address a few announcements. As always, we like to encourage you to send in your questions so they can be answered live on air. Our email is thefinalbar@stockcharts.com. And you can tweet us at finalbarsctv, at finalbarsctv, on Twitter, that is. Or you can put a comment below this video if you're watching on the YouTube channel. Also, I want to encourage you to go to our on-demand platform to watch all of StockCharts television shows at any time. That website is stockchartstv.com. And don't forget to check out Sector Spotlight every Tuesday from 10:30 to 11 a.m. Eastern. Sorry, Dave, some shameless self-promotion going on here. You should have been here. Finally, I'd like to share the guest that Dave Keller will be interviewing next week on the final bar. On Tuesday, February the 7th, he'll have Ari Wold of the Oppenheimer Group. On Wednesday following, February the 8th, he'll be chatting with Joe Rabel of Rabel Stock Research. And then finally, on Thursday, February the 9th, Dave will be interviewing Jesse Felder of thefelderreport.com. All three of these guys are returning high-quality guests of the final bar, so I encourage you to tune in. And now let's continue on with the final bar mailbag. The first question that came in is, what role or weight would you put on the Baltic Dry Index, which is hitting a new low? So first of all, I have to admit that is not my specialty. So first of all, I had to do a little bit of research. And what I thought to do is, when you talk about impacting something, or when two metrics are working together, the first thing that I want to do is look at the correlation, because that tells you how one can impact the other. If correlation is 1, you can expect them to move in the same direction. The correlation is -1, you can expect those two metrics to move in opposite directions. And what I've done here is I've put the Baltic Dry Index together with the Dow Jones Industrials Index, and the lower pane here. So this is the Baltic Dry Index, which is $BDI. which you can actually pull off here at StockCharts.com. So the ticker symbol is $BDI. I've plotted that below the chart here. And you can indeed see that that is coming off hard. It's coming down hard of really high highs. And my problem, quote unquote, with this is that the correlation is not in sync. So from time to time, it's got a very high correlation, but also from time to time, it's got a very low correlation. So sometimes it moves in sync, they move up at the same time. But as you see right now, correlation is almost -1, which means that they're moving in opposite directions, which is exactly what you see. Now, from a quick eyeball study, what I think is happening, and the way I think you, but please do your own research, is that when the correlation is high, the Baltic Dry Index seems to lead. So when you move up into a nice big high, you can see that the BDI is turning over early. So that is where it's leading. On the bottom side, not so much. Here again, when you see the market is rallying, you can see high correlation, and then it rolls over first. And we had the same here when we had a period of high correlation, moving on first. So my take on this BDI is that it works very well when the correlation is high and the market is rising, not so well on the other side. So let's move to question number 2. And question number 2 deals about volume, talks about volume. How does the volume bar chart differ from the accumulation distribution indicator? What are common reasons for divergence, and does volume have the same meaning as it had 15 to 20 years ago? And the accumulation distribution line is actually a very good article on the Chart School website. So if you have ever questions about indicators, about interpretation, check out the Chart School website. There is a lot of information there, and you will find exactly what that AD line is doing. I'm not going to read it all out here for you, but the big difference between a straightforward, straight up volume bar chart is that that bar chart, that volume, gives you the traded volume on that day, nothing else. The AD line is doing a calculation, a mathematical calculation using volume and price to basically determine whether the up move is taking place under high volume or low volume. And that can give you a lot more information than just outright volume. So please check out that Chart School article on the AD line and play around with it, and you can compare it with the volume bars on your own charts. So here is the third question on the mailbag, and that comes for a very specific stock. So does the tilted neckline or the right shoulder retest invalidate this inverse head and shoulder of CSCO? So here's the chart of CSCO, and the first thing that I wonder is this really a head and shoulders? Because I think it's kind of asymmetric. Tilted is always kind of difficult. I think you could sort of read a head and shoulders into it. So let's assume that it is a head and shoulders. So this retest, I don't think has retested yet. We still have to reach that neckline. So we have just formed that right shoulder, and maybe the person who asked that question was referring to that little hiccup that we had here, which didn't even reach that tilted neckline. I'm going to say that if we're going to move up, and we say that this is a right shoulder, then this is the right shoulder all together. So I'm not too worried about the fact that we have two lows in this. This can be the right shoulder altogether without any problem. So we have a left shoulder head and a right shoulder. But again, I'm not 100% sure whether this counts as a head and shoulders pattern. If it is, then it's not a problem that we have two lows here. And when we break that overhead resistance, and that's the nice thing with tilted necklines, you break to new highs, you take out resistance before you take out that neckline, and horizontal levels are always way more important than diagonal difficult word, levels. So all in all, if CSCO was able to really clear that $50 level. I'm pretty sure it's going to take out that neckline as well, and it's in for a treat towards maybe 56 or the former high here. Let's go to the fourth and last question on international stocks. And this is a question that's dear to my heart. And I realize I have forgotten something. I'm going to wrap this up and then I'm going to go back to question 2 if we have time. Let's talk about the international thing first. So international stocks have had an incredible run with the weaker US dollar. Is it too late to chase this theme? And again, obviously, I want to look at that on an RRG because I think that gives you want to have a theme, you want to have a bigger picture, you bring on the RRG. And what you can see here is that basically so we're comparing all these international indexes with the Dow Jones Global. And what we see is that Hong Kong, the Hang Seng Index, and Europe are inside leading. Europe is already rolling over and the Hang Seng is touching, I know that, I looked at the chart, at a very important resistance level. So that's going to roll over fairly soon, I believe. If you look at all the others, you see that they are sort of shooting off into that lagging quadrant. So they have had their run. That's the thing. The problem is that a lot of US dollar-based investors are looking at this chart through dollar eyes. And what I've looked here as are the indexes, the underlying indexes, instead of the international ETFs. So watch closely. Look at this chart, and now I'll bring up the international ETFs. Look at this. So this is a completely different chart. And the difference, why this is happening, and you would be inclined to say that that's all really good, but I hope that you think that you agree with me, that the previous chart was showing you that a lot of these international markets were shooting off inside a lagging quadrant. So what you're actually looking at here is a very strong move of the US dollar. So basically the US dollar weakening, which is putting all these international markets into strength. And that is a thing, I can't stress this enough. When you want to trade international markets, you got to dissect, you got to look at the underlying index, and your tool to get exposure are the ETFs and not necessarily the underlying index. I quickly want to go back to the question number 2 on the volume, because the second part of that volume was, does volume have the same meaning as it had 15 to 20 years ago? And my opinion on that is no, it has not. 20 years ago, exchanges were the sole market where everything was traded. That was the total volume in the market. Right now, with all these ETNs, off-market, dark pools, over-the-counter markets, volume is a lot more spread out. So you can't really rely on volume being reported totally. So with regard to any volume indicator, they still have value, but I don't think they have as much value as they had 20 years ago. We got to wrap this up, guys. I need to start doing my 3 in 3. So here is my first chart for the 3 in 3. And those of you who are reading my blog and watching Sector Spotlight may have seen this chart before. This is the ratio between growth and values, the Dow Jones US Growth Index divided by the Dow Jones Value Index. And we had this massive double top here that was completed back in, that was here at the end of March. And it was already a signal right here where we couldn't push to new highs. But when we broke that in-between low and completed that massive double top, that was really the signal for value stocks to start beating growth. And you can see how heavily that went. We had one more push up, and then we went all the way down. And we kind of touched exactly what the target was based on that double top formation. And we're now rallying strongly off that target, which was lining up with the peak here in 2018 and that ensuing low in September 2019. So for the time being, growth is back on the map. They're beating value, and we're back above that former support level, which was acting as resistance, but didn't really do it. So it's opening up the way for further improvement in growth in the next couple of weeks. Is it a complete turnaround of this trend? No, it's not, because we still have lower highs and lower lows. So there is a little bit more needed for this whole thing to turn around. But for the time being, we're looking good here in terms of growth over value. Another chart that I am looking at a lot is the comparison. I look at sectors through RRG, and usually we use the spiders, so the XLY series. These are State Street spiders. They're tracking the S&P 500 sector indexes. But there is a family of indexes promoted by Invesco, and these are equal weight indexes. So these are not as impacted by the heavy weight of a few of those mega caps. And we know that XLY is impacted heavily by Amazon and Tesla. Has been all the time. And you can see here in this chart, so this was all the way up. The cap-weighted version beat the equal weight version. And that had a blow-off situation at the start of 2020, came down, moved sideways, and now we see a very strong move of improvement for the equal weight version. So what this tells you is that the broader stocks inside that consumer discretionary sector are actually starting to pick up. They are now starting to do better or being less heavily impacted by Amazon and Tesla as the mega caps in that sector. So all in all, if you want to bring that back to that growth value story, where consumer discretionary obviously is the ultimate growth sector, when Amazon and Tesla were taking a beating, those stocks couldn't really shine. They couldn't really pull that off, and they are doing that right now. So we're back on the map with consumer discretionary. For the time being, it's the equal weight stuff that is leading the charge. But if Amazon and Tesla can keep up what they're doing, especially Tesla's doing really well, Amazon has a little bit to digest. We had a nice run up, but it came off today. So we'll have to see how that goes in the next couple of weeks. But all in all, consumer discretionary looks really nice. And then finally, to wrap up the show here, I just had to make it easy for myself. I want to look at the chart of SPY. Obviously, that is what everybody's looking at, and so am I. Here is the falling trend line that we took out. Most importantly, 4100, 410, 408, 49 in SPY is taking out, and for the time being, we're holding up above that former resistance level, which is now expected to hold as a new support level for a jump higher. If that happens, my next target for the S&P 500 is around 430, 428.6. Ladies and gentlemen, thank you so much for sticking with me. I hope you enjoyed the show. Spoiler alert, you have to deal with me again next Monday because Dave will still be off. He'll be back on Tuesday. Thank you so much for staying with me. Thank you so much for watching. Please keep on checking all the shows on StockCharts Television. And I wish you all a very happy weekend, very good weekend. And I hope to see you next week. Thank you very much.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.